Hello guys, in this knowledge module we'll talk about the liquidity ratios. So first of all, we know that the liquidity is about the obligations which company has to fulfill in terms of the cash payments coming due specifically within 1 year period of time. So those obligations are due within 1 year period of time, and the companies not only the company, it depends what is the role uh, of yours being an analyst. You might be the supplier, so you are concerned that whether the company to which you are supplying the things on the credit term basis, whether the company will be able to pay you in time or not. So the liquidity ratios will tell the analyst about the company's position, uh, uh, whether it will be able to meet its short-term obligations or not. So we have learning objectives. There are four liquidity ratios, very popular traditional ratios. One is the current ratio. We'll talk about that. Then the second one is the quick ratio or acid test ratio. So these are the two names for this ratio. Third one is the cash ratio, and finally the net working capital to the total asset ratio. There are there are five types of ratios under the ratio analysis. So ratio analysis brings the companies of different sizes on the equal footings, where you are trying to find the financial performance of the companies by linking or establishing the relationship between the different components on its incomes on its financial statements. So in a ratio, the component can come from the both component. We know the ratio, there is something in the numerator and something in the denominator. So those component can come either from the income statement, or they both can come either from the balance sheet, or they can come actually from the cash flow statement as well. Over here, mostly we will be talking about the components which will be coming from the income statement and the balance sheet. The five ratios are the liquidity ratio, asset management ratio, the long-term debt ratio or debt paying ability ratio. Fourth is the profitability ratio, and fifth is the investor ratio or the market valuation ratio. So we will only talk about the liquidity ratio. So the liquidity ratio are calculated in short to find out the ability of the firm to meet its cash obligations, which is coming due within 1 year period of time. This is the very specific definition. So in the short term, company focus on on the on the liquidity, whether they want, like, how they can remain liquid. In the long term, the company is all about profitability. But in the short term, if the company will not be able to meet its cash obligation, then it can go bankrupt. Like, there might be utility bills you have to pay, and those utility bills, if they are coming and due in 30 within 30 days, you are more worried about them compared to any other your personal financial objective. So those obligations which are coming due for a company within 1 year period of time, it should be of it should be of most importance for the company. And we need to check through these liquidity ratios whether the company will be able to meet the obligation or not. So liquidity means a business has assets that can quickly and cheaply converted into the cash. Liquidity ratio compares the firm's liquidity assets to its short-term obligation, and we try to like, when we are calculating these liquidity ratios, we also need to see what is the benchmark, and the benchmark means that what are the value for these ratios for that particular year from the industry. So what is the industry average? So there are 6, 7, 8 companies in the industry. What are the if you like add the ratio, compute the ratios for those individual companies and take their average, are your is your ratio is close to that, and this is what you want. You do not want it very below par. You also do not want it above that, and we'll discuss it why we do not need above that. So first of all, the because I'm right now, just for the illustration purpose, I'm considering a company which is the Lululemon, uh, which is the company in the business of designing and distributing and marketing the athletic apparel. And for the balance sheet and the financial statement issued on the 2nd February 2020, means from the fiscal year 2019, I'm using this data. And the current assets, the first ratio is the current ratio, which is the ratio of the current asset to the current liability. So the current assets for the Lululemon is 1,807,938 divided by 620,418, which is the current liability. These numbers are actually in thousands, but we are ignoring the last three zeros. So even if you will place the last three zeros over here and in the denominator, they will cancel. And the ratio is suggesting 2.91. Anyone can do the computation. The main thing about the ratios, whenever the ratios will come, is about their interpretation. Try to understand that what does it mean, and also define your role. Are you analyzing for your own company, or are you analyzing from the perspective of the supplier who is supplying the things, or giving the credit, short-term credit to the company? So the role is important. Over here, the interpretation is that for every single dollar liability coming due within 1 year, so it's a current liability, the company has $2.91 available in the shape of the current assets. Seems like situation is pretty much in control. We also need to see the trend over the period of time for this ratio. For example, if I'll go into the Excel file, you can see that I have computed it for the previous 2 years as well, and saw that this is the trend, and it is going down. Being a supplier, I want it higher and need to this ratio to increase over the period of time. But it is not always good from the company's standpoint of company's point of view, because might be you are holding a lot more cash which you should not hold, and just this ratio is getting increased for the creditor. It does not necessarily good for you. Yes, it should be close to the industry. That's why the benchmark is important. If you do not have the number, the average of the industry, then take the average of the closest competitor for the last 3 years. So either for the same year, take the average for the industry. So if there are 7-8 companies in the industry, compute this ratio for them and take their average. And these ratios can be available through the many databases, and you can compare that average with your number. If you do not have whatever is the closest competitor, if you are working on, compute these 3 years of the ratio for that. For example, I have computed it for the Under Armour and took its average and found it is 2.35. So relatively it is close. Over the period it decreased, right? From the creditor's point of view, it's not good, but like this is not telling me that it is necessarily a bad thing happening, because I might do not want a lot more cash stuck in my current asset. But definitely it is, if you see its competitor, it is relatively close. So coming back to the slides, so the interpretation first of all is important, and we have seen that over the period of time, Lululemon's this ratio is decreased. And one thing about the calculation, if you are using the Excel, it's not an hard thing. If you have the balance sheet over here and the income statement of the Lululemon, and now you want you do not have to manually calculate it. Simply let's suppose if these three ratios I have to calculate, this one and this one. So simply it's a current asset, so is equal to go into the balance sheet and see where is the current assets. So we can see that the current assets, total of the current assets is there, divided by total current liabilities, which is this, right? And if now I press enter, this ratio is calculated automatically for me. And now if I'll simply drag, and in those like worksheet where from where the numbers are coming, the uh, the balance sheet numbers of the previous years are just adjacent, it will automatically calculate the ratio for me. So we can see over here it is coming F10 F divided by F29. So yes, this is F10 now divided by F29. And likewise for the fiscal year 2017, whose statement issued on 28th January 2018 for Lululemon, it should be G10 divided by G29. And we can see over here this is G10 divided by G29. So simply I did the calculation for one and dragged it over the other cell, and the calculation appeared over here. The similar things I have done for the other ratios under the heading of the liquidity ratio. And I will take their average and put it in the front of the Under Armour's liquidity ratio, so that I can compare that how the Under Armour liquidity ratio is performing versus the average of the 3 years of the Lululemon liquidity ratio. Again, if you have an industry figure, that's better. Do not then use the competitor average for the last 3 years. Use the average of the industry only for that specific year. So if you have the number, for example, from the industry for this ratio, take the average of the industry for only this year, means fiscal year 2019, but issued in might be either at the end of the 2019 or at the start of the 2020. But if it is not available, then yes, compute the three ratios or the ratios for your closest competitor for the 3 years, and take its average and try to compare this number versus the average of the 3 years of the closest competitor. I still have to check the Under Armour like numbers from their income statement and balance sheet. In this case, balance sheet, because both the numerator and denominator is coming from the balance sheet in order to finalize it. But if say this is the number, we can compare it that it is relatively close, right? Going back to the Excel file, sorry, the PowerPoint file, you need to understand that it is not necessary that in a given industry this liquidity this current ratio will always be in a higher number. Now for the industries where the net operating cycle is small, the optimal current ratio, like it should be, can be even less than 1. For example, if the first of all, what is the net operating cycle? The net operating cycle means when the company spend the cash on the inventories. From that time, the time from that point till the company will receive the cash from its receivables. So they bought the inventories, they might have converted those inventories into the finished goods, they sold it and generated the cash, the account receivables, and then they collected the cash from those account receivables. So that point from where they have spent the cash on the inventories to the time when they have received the cash from the account receivable, that is the net operating cycle. And if it is a shorter net operating cycle, then the optimal current ratio can be less, and even less than 1. No problem with that, because the company is very quickly generating the cash. But if the industry is like Boeing, which is preparing the aeroplanes, and it takes much more time to sell them or the aeroplanes to the airlines, the net operating cycle can be very big. So for that, for those industries, for the industries, aeroplane, commercial aeroplane making industries, this net operating cycle can be high. So likewise, the current ratio will be also high. They needed to have enough liquidity under the current assets so that they can meet the current the the obligations coming due in 1 year. Now, what are the limitations of the current ratios? First of all, the current ratios can be overstated. Usually, the companies they close their fiscal year at a very high period of time where when they have a lot more cash, they have far less accounts payable to pay, so their current liabilities are very less and their current assets are very high. So one way to counter that issue is to keep calculating the current ratios at different point in times whenever the company's balance sheet comes out. For example, try to calculate it after each quarter. So after every 3 months, the company might be company has to issue Lululemon, for example, in this case, need to issue the income statement. So they will issue 10Q, and in 10Q there will be the balance sheet. Use that balance sheet and calculate its current ratio to find out that what is the numbers getting generated over there. One, this is the way out. The other limitations are within these current assets. You have all the things. For example, you have account receivable, you have also the inventories. So account receivables, are there any aging account receivables which are past due? For example, they were expected to be received within 1 month period of time, but it's almost a year, like it's almost 7-8 months, and the receivables are getting getting aged and they are past due. If this is the situation, might be the quality of the receivables are not good, and even when the quality are not good, this ratio will not tell you anything about the quality. So you still think that the company have enough liquidity available to meet its current obligation which is coming due in the next 1 year. The second thing is inventory. If the inventory is moving very slowly, might be there are damaged inventory or obsolete inventory, and these inventories are still considered as a part of the current asset. So again, the quality of the inventory will not be reflected under the current ratios. Finally, the cash can be restricted. For example, for Pepsi and Coca-Cola, if I correctly recall, there is some restricted cash, and that cash can needed to be used only for a specific purpose and cannot be used for to meet the liquidity obligations for some of the suppliers. So if I am the sitting on the supplier side and doing the analysis of the company and need to decide whether I have to give or supply the raw material to the Coca-Cola or Pepsi on a relaxed term basis, this restricted cash is the key factor in my decision whether to extend or whether to give the supplies or raw material to the Coke or Pepsi on a lucrative terms or not. So restricted cash you have is very important, and this ratio will not tell you about the restricted cash, because the current restricted cash even is a part of the current asset and will be used in the calculation of the current ratios. Now, because of these issues, we need to look some more liquidity ratios, and those ratios are more conservative in nature. For example, next is the quick ratio or the asset test ratio. So we take away all the other items from the current assets and we'll see that which are the most liquid ratios, liquid assets, the first few liquid assets. So we know cash and cash equivalents. So where the cash is the simple cash equivalent if you have invested in the treasury bonds, and because there is no risk in the treasury bonds, the government is most likely to meet its obligation. So those are under the cash and cash equivalents. There might be some short-term investment. The company has put some funds in the fixed deposit for 3 months with the bank at some guaranteed rate, So that is relatively less risky, still more risky than the investment in the treasury bonds, but it will be like it will be converted into the cash. This short term investment will be converted into the cash. Then you have account receivable. Most probably the company will be able to get their receivables and will be able to convert them into the cash. So cash plus and the cash equivalent plus the short term investment plus account receivable, if we'll take them in the numerator and divide with the current liabilities, we'll get the quick ratio. For the Lululemon, this is the ratio, which is 1.83. So if you add all these numerator items, line items from the balance sheet, we'll get 1,133,724 in the numerator and the denominator, where we have the current liabilities. And if you see the trend, we can see the trend is 3.45, it coming to 1.83 in 2019. In 2020 it is 1.83. Now again, the interpretation: for every dollar of liability coming due in 1 year, the company, or Lululemon in this case, has $1.83 available for cash, from the cash, short-term investment, and the account receivable. From the point of view of the supplier and the creditor, the better, because it means they are more confident about the company's ability to pay the short-term obligation. But it is not necessarily good from the point of view of the company, because if they have a lot more cash or short-term investment, it is not a good sign. The company is earning low return through the short-term investment, compared to the situation where they can invest back into the company or start new project, or if they do not have a project, then pay them as a dividend to the shareholder, so that they can invest it and get a reasonable rate of return. Ideally, this ratio should not be less than 1. This ideally. And again, it is better to compare this number with the industry average for the same year. So if I'm comparing this year's number, 2020 1.83, then ideally I need to compare this number with the industry average for this year, this specific year. So again, in the industry, you have might be in the same industry, you might have many companies. So if we have the ratios for each of those companies and take its average, that we need to compare with this number, or in fact we need to compare the quick ratios number of the Lululemon with its industry average. One question obviously that come to your mind is why there is a sudden jump over here. So I tried to figure out that what could be the reason, and I figured out that there are two items which actually increase. So we know that in the numerator you have the cash, short-term investment, and we have the account receivables, and in the denominator we have current liabilities. If you see, for the 2019, all of a sudden the account compensation liability under the current liabilities, the account compensation, accrued compensation, and the related expenses suddenly increased. And one reason was the restructuring, and they in order to do the restructuring, they offered lucrative compensation to the existing employees before laying off. So that number has increased, and because in the denominator the number increased, that decreased the overall ratio. Likewise, compared to the 2018, if you see that accrued compensation was still a big number over here, and further current lease liabilities also increased, and the current lease liability was in the denominator. So overall current ratio actually got decreased because of these two items. And why the current lease liabilities are there? The company is going into the expansion. They have opened 50 stores recently, and there are the lease related current liabilities which is coming due in 1 year. So this was actually the reason why suddenly there is a big change, and the current the quick ratio actually decreased a lot in 2019 and 20 compared to 2018. Finally, we have an other, not finally, this is the third ratio, the cash ratio. And this is more conservative. We even take out the receivables from here. And these are the cash plus and the cash equivalent plus the short term investment. Only those things which can be converted into the, which are already almost a cash, and they can like quickly will be converted into the cash. So this number is suggesting us for Lululemon, they have, for every dollar they have 1.76 dollar available in the shape of cash. This is cash, actually cash, and the short term investment. uh, this number we do not need to be very high. Like, the main thing, if this number is very high, more than one, even it can be less than one, if it is very high, it means that company have enough cash. And like, again, from, if your role is a like your role is being a creditor or the supplier, then you need it more. But if your role is being an stock investor and you want to see that and if all of a sudden you analyzed the liquidity ratios and you found this is the number, you want that cash to be invested into the project or to be distributed among the shareholders so that you can get a better profit. So you do not want company to hoard money in the shape of the short term investment where they are getting a very low returns. This is the last ratio, which is the net working capital to the total asset ratio. And net working capital is the difference between the current asset and the current liability, which is, so this in the numerator you have actually the liquidity reserves, means after paying the current liabilities, whatever is the leftover. So this is also called the liquidity reserve. And this ratio is simply telling us that the for the 2020 numbers, when the statement got issued on 2nd February for the Lululemon, uh, the liquidity reserve as a percentage of the total asset for the Lululemon is 36%. And again, if you are a creditor, you want this number to be big. And over the period of time, if it is increasing, it means that you are confident that company have enough liquidity reserve uh, to after paying their as a percentage of the total asset, and you are confident in, you will be confident with this number to be high if you are the creditors, that the company will be able to pay its obligation, which is will be coming due in 1 year. And after paying that, the company will still have enough reserve as a percentage of total assets. So you want this number to be high. So in summary, we have learned about the 4 liquidity ratios: the current ratios, quick ratio, cash ratio, and the net working to total asset ratio. I want to show you last my Excel file, and if you see that this is the ratio analysis page or worksheet of the Lululemon, and you can see all these numbers I have calculated over here. This fourth one is not the ratio, but I use this number from here to divide it with the total assets. So if you see the number, this is D6, so D6 is actually this, divided by Lululemon balance sheet E18. So E18 should have the total asset when I'm calculating the net working capital to the total asset. So D6 divided by Lululemon balance sheet E18 cell. So E18 cell, this is the Lululemon balance sheet, and E18 cell is actually the total asset. So this is how you do the calculation for each of the year for your, if you have a main company, and for the competitor company, it's 3 years. These ratios 3-year average should be in front of this. So likewise, when I'll be taking their average of the Lululemon, I'll put it in front of the Under Armour, uh, just for the comparison purposes. Thank you.